Welcome to MBA third year students of Dr. B.R. Ambedkar Open University who are pursuing finance specialization. The topic for today's discussion is relevant costing. The experts with us for the discussion are, left to me is Professor R.K. Misra, Director IPE. Extreme left to me is Dr. K. Swami, Professor of Business Management, Dr. B.R. Ambedkar Open University. Cost is very important for management. Cost is required to measure the performance, profitability and fix the selling price. Now I ask Professor R.K. Misra, what are different methods of accounting?
Accounting is a specialized branch which has developed over the last 400 to 500 years. In accounting, we start with bookkeeping, which is the lowest thing to do, where we just take into consideration the books of accounts, and from there we proceed to financial accounting, which measures the overall financial performance of an enterprise in terms of profits, in terms of assets, in terms of liabilities, and from there we go to cost accounting, which is somewhat different from financial accounting, because financial accounting talks of the financial performance of the enterprise as a whole, whereas in the case of cost accounting we talked of products, we talk of costing of the products, and from there we go to management accounting. There we keep into mind both the financial accounting and cost accounting and see how the inputs provided by these two types of accounting can help the management in taking decisions which can help them in optimizing their profits or optimizing the use of resources.
Dr. Swami, what is decision making?
Decision making, as it is, you are aware, management is nothing but making a decision. So decision making is nothing but coming to a conclusion whether to act or not to act. That is the decision making. For taking any decision, we need information, we need data, we need to have the information about the total or related to the particular activity. Unless we have the data, we cannot take any decision. So for taking a decision, whether it may be fixing the price or it may be making a product on our own or buying it from outside, or at times the management may confront with the different kinds of problems, situations. To handle the problems, we have to take a decision. The objective of any business is to make profit. So we have to have profit consciousness every time. We have to measure how much we are receiving, how much we are spending, what is the surplus that is going to be generated. So in this direction, we need to have total information, total data related to the activities of a business during a particular period. So decision making is nothing but what kind of activity can be taken up or what kind of activity cannot be taken up. So that is decision making. So we are concerned with accounting here, the role of accounting in decision making. So whether a particular decision is going to maximize the profit of the business or not, that is what we have to measure all the time. So because the very purpose of any business is to earn profit, to realize that objective, we need to have the information. Depending upon the information available, depending upon the environment, depending upon the situation, we have to take appropriate decisions that maximize the wealth of the organization. That is decision making.
Thank you. So Professor Misra, how the selling price is determined?
Thank you, Mr. Reddy. As Professor Swami has just mentioned, profit is the crux of all the business activities, and there costing plays a very, very great role. So when we talk about how selling price is fixed, we have to basically go to costing, and we have to take into consideration different kind of costs. Now we have two categories of prominent costs. One is known as indirect costs, the other one is known as direct costs. When we talk of direct costs, we talk of direct material, we talk of direct labor, we talk of direct overheads. When we talk of indirect costs, we talk of indirect material, indirect labor, and indirect overheads. Now, these are very well defined and established categories. And what we have to do is that all the costs that we incur, we group them under these subheads, we total them up, and then we get the indirect total of indirect costs and total of direct costs. Now then comes the question of the profit element. Now, whereas indirect costs and direct costs, they are facts because we have incurred them and we can't play with those figures. So they are facts. But when it comes to profit, then it can be the question of policy. How much profit you want to add? Whether you want to add less profits, you want to add more profits, you have to keep into consideration the situation of the business, also the kind of product that you have been producing, the conditions of market. If supposingly you are launching a product for the first time, it is a high technology product, as you know yourself, you have been dealing with IT. In the initial run, we can put as much profit as we like because we may follow a scheme of skim the market. But if that is not the case, and if there are so many competitors there in the market, then we can't skim the market. We may have to follow a penetration pricing. On the other hand, supposingly you are in administered pricing regime, as is the case with, let us say, petroleum industry, the case of gas industry is there, the case of fertilizer industry is there. In all these cases, whether it is the question of public sector or private sector, you have to go through the administered pricing regime. In administered prices, different components are given and the normative costs are worked out, and on those normative costs a profit element is added, and that profit element when added, and what you get as sum total of that will be your selling price. So selling price is composed of different kind of costs plus profits, and as we just discussed, one is concerned with the facts, the other one is concerned with the policy, and your policy will depend upon the policy that you have evolved for the business. Your policy will also depend on what is happening in the market. Since you are a part of the macro economy, therefore what is the policy of the government, that will also do a lot. Now I think the question comes, what are direct costs and what are indirect costs? That's a very, very interesting thing. But normally when we talk of direct costs, we say direct labor. Now direct labor mostly is that part of labor which whose cost can be directly ascribed to the product. For instance, supposingly I'm in a TV factory producing TV, and I'm working on the shop floor. So whatever cost is incurred on me, there on the shop floor, that can be a sort of direct labor. But at the same time, supposingly we talk about the watchman in the factory, who is sitting, at the gate, and in that factory we are producing, TV on the one hand, we are producing certain other things on the other hand. Then I think his cost can become, a sort of indirect cost. So there is a very well established kind of, division there, and we have to follow that to work out the indirect costs and direct costs.
Thank you, sir. Dr. Swami, will you please explain what are relevant costs and what are irrelevant costs?
Let me supplement here, Professor Misra ji. When we were talking about financial accounting, it covers the overall profit of the organization made during a particular year. But when we talk about cost accounting, it concentrates, it focuses only product wise. Instead of looking at overall performance, it will take up the product or services that are being rendered by the institution. So cost accounting basically has certain important aspects. As Professor Misra ji was talking about the direct and indirect cost, let me further classify here. The cost that are likely to be incurred in any business organization can be classified in two broad ways. Number one is product cost. That is, if you want to produce something, you have to incur certain expenditure. That is product cost. Whatever expenditure you are incurring is going to be called variable cost. Here the assumption is, if you produce that particular product, you have to incur this cost. If you do not produce, you need not incur this cost. That is why we call it product cost. Same thing, we are using a different nomenclature, variable cost, because it varies directly with the output. If there is output, you are going to incur variable cost. If there is no output, you are not going to incur any variable cost. That is one classification. The other classification is period cost. Period by name itself, 1 month, 1 year, like that. So, periodically you have to incur certain amount of expenditure. So, irrespective of the output, periodically you have to incur certain expenditure, whether you produce or not. So, this is going to be period cost or fixed cost. These two are very, very important for a cost accountant, cost manager in any industry. So, if you analyze the total direct cost, that is total cost incurred on material, that is direct material, direct labor and other direct expenses. If you add all these things, you will get prime cost. Whatever cost you incur indirectly within the factory, known as overhead. So, the idea here is any overhead is indirect cost. So, indirect cost can be incurred either within the factory or outside the factory. That is, it could be either in the administration or elsewhere in the sales and distribution management. So, all these things will go as indirect cost, but the prime cost, that is direct material, direct labor, direct expenditure, is known as prime cost. So, for fixing the price, once you arrive at the total cost, that is fixed cost, I mean direct cost or prime cost, then factory overhead, then administrative expenditure plus selling and distribution expenditure, you will get total cost. Total cost, a percentage of profit, as explained by Professor Misra ji, it is a policy matter. Whether you would like to have profit as a percentage on the cost, it will be added, thereby you will arrive selling price. But the question here is, when we talk about relevant costing, what is relevant, what is irrelevant, we have to distinguish very clearly. Relevant cost is when you have selling price, that is sales. Sales minus variable cost will give you contribution. The formula here is selling price minus variable cost will give you contribution. You may ask me, what is contribution? Contribution is nothing but contribution towards the recovery of fixed cost. So, whenever you fix selling price at a particular rate, that selling price must be in a position to recover the variable cost plus profit, a portion of profit. So, selling price minus variable cost will give you this contribution, contribution minus profit, minus contribution plus profit will be the selling price. So, that is how we classify. So, whenever you want to take any decision in cost accounting, what we see is, in case of bad situation, in case of unpleasant situation where the firm is not earning profit, where the firm is incurring losses, where a firm may produce more than one product A, B, C in this way. Some products may yield profit, some products may yield loss. Immediately, by looking at the profit and loss, we cannot take a decision whether to continue a product which is incurring loss or a product which is earning profit. That is not the criteria. So, what we have to judge, what we have to decide here is, after recovering the variable cost, okay, is there any contribution towards the recovery of fixed cost or not? The assumption is, in case of bad unpleasant situation, as long as there is a positive contribution towards the recovery of fixed cost so long as one can continue the output or that particular product. That is called relevant costing. So, our focus, our thrust here is, are we in a position to recover the variable cost or not? So, first you have to recover the variable cost, that is production cost. Once you recover the production cost, whatever you contribute, that is going to minimize your loss. I mean, whatever contribution is there, that is towards the recovery of fixed cost. So, in this case, the total variable cost you will likely incur in any business organization is going to be relevant costing, and the cost which is permanent, I mean the cost which is fixed, is treated as irrelevant cost.
Thanks for elaborate reply. Professor Misra Saab, for decision making, which costs are important? Distinguish between again fixed costs and variable costs.
I think Professor Swami has done it so well that I can only add a bit there. He has explained very well that there are two kinds of costs. One, they are known as fixed costs, the other ones are known as variable costs, and he was stating very clearly that fixed costs, they become irrelevant costs because he used the word sunk costs. They are the costs which are sunk, whether you like or not, they are there. Yeah. So you have to see what you can do so that you can earn something, and through that earning you can meet the fixed costs. So he also used the term cash profit, or he was using the term contribution, where he told that we take sales, and from sales we take direct variable costs, and what then comes is contribution, and this contribution enables us to meet either whole of the fixed cost or part of the fixed cost. So in any decision making, what we have to see is how much is the revenue coming from the sales, and from that how much we have to provide for the direct costs, and then what is left to us. So I think naturally, I think when you talk of costs and the areas where you have to prune, you have to see that you increase your sales, then you control your direct costs, so that you get basically a handsome amount of contribution which can enable you to meet your obligations towards the fixed costs. So when you are talking what are the relevant costs here, certainly as Professor Swami stated in I think two terms, and very clearly the direct costs, they are I think the relevant costs. The variable cost, I think they are the relevant cost, I think, and we have to see if we can recoup the variable cost. Certainly I think then we can take up, as he told, product costing, we can take up the manufacture of that product. Professor Swami also talked about a very interesting thing, that there can be an organization which can have a mono product, there can be an organization which can have multiple products, and I think so is the case with the service industry also. You have enough experience of the banking industry. Now in all these industries, what happens is that we don't have only one service, we don't have only one product, we have multiple services and multiple products. So what we can do there is, we can see what are the fixed costs, and to what extent the monies that come from different services is, helps us in recouping the fixed costs, and then we can find out which product is useful for us to continue with, and which products are not good, and we can drop them from the product line. Of course, there will come the question of the apportionments of the cost, and for which there are different methods.
Thank you, sir.
Let me supplement Professor Misra ji here. When we talk about the fixed and variable cost, sometimes what happens is some products may have higher amount of variable cost but very nominal fixed cost. Contrarily, sometimes the variable cost may be very nominal and the fixed cost may be very high. Under those circumstances, automatically when you look at the contribution, wherever in case if the fixed cost is high, automatically the fixed cost whatever you incur has to be recovered. You have to be whatever fixed cost is there, that has to be recovered. Unless you recover the entire fixed cost, you are not left with any profit. To arrive at the profit, the entire fixed cost has to be recovered. For this purpose, you have to look at the amount of variable and fixed cost that is involved in any particular product. In case the fixed cost may be very high, so contribution may be positive, contribution may be positive, but you have to see that the entire fixed cost is recovered. Just by looking at the positive contribution, we cannot take any decision. Here, this will help us to calculate or to establish a kind of relationship between the cost, profit, volume. Normally, basing on this, we calculate a PV ratio, that is profit volume ratio, PV ratio which will tell you to calculate the break-even sales. So, break-even sales is nothing but a point where the firm's revenue will be equivalent to the expenditure. So, where the entire revenue is equivalent to entire expenditure, that particular point is known as break-even point. So, once you reach the break-even point, you can think of many other managerial decisions, like if you want to earn certain amount of profit, what must be the sales? If you want to earn certain amount of profit, how the selling price can be fixed? If you decrease the selling price, what are the implications? If you increase the price, what are the consequences? All these things can be calculated by using this formula. So, here we are broadly classifying the cost into relevant and irrelevant cost. So, relevant costing is nothing but variable cost, irrelevant is nothing but fixed cost. Okay. So, depending upon these things, we have to take decisions in the environment in which we are operating.
Again, Dr. Swami, what factors should be kept in mind while going for certain decisions like making or buying, continue with the loss or setting down the factory in a more specific way?
Okay, here as it is, Professor Misraji very elaborately explained about the implications of fixed and variable cost. Okay. Now, whatever is the selling price, first our aim is to recover the variable cost. Once the variable cost is recovered, our focus will be shifted towards recovering the fixed cost. Okay. So, if you want to make a product on your own, or if you want to buy a product from outside, by buying from outside, what is the amount that you are going to create as a surplus? By making on your own, what is the amount of surplus that you are going to create? In case you buy from outside, you have only one price. In case if you want to manufacture on your own, you have to combine variable cost and fixed cost. Combined cost you have to take here. As long as your buying price is lower than this, you can buy it. If it is more, you need not buy it. That is make or buy. In case of whether to run the factory with loss or shut down the factory, even here the same formula will work out. That is, as long as you are able to minimize the loss, because we are talking about the product which is incurring loss. As long as you minimize the loss, suppose by producing a particular product, let me say, let me take a small example here. You have fixed cost of rupees 10,000. You have fixed cost of rupees 10,000. You have contribution to to the extent of, let me say, 3,000 contribution is there. So, your contribution is 3,000 rupees, your fixed cost is 10,000. Now, what is your loss? 10,000 minus 3,000, it is only 7,000. In case if you stop this production, if you stop this product, what happens is you have to incur the entire 10,000. That is whether to continue with loss or shut down. So, that is how, as long as you have positive contribution, you can continue. Let the product does not add to any profit, but there must be positive contribution towards the recovery of fixed cost. So long as you earn, so long as you have positive contribution, you can continue the product, because that is going to minimize your loss.
How does relevant costing helps in maximizing the profit?
See, relevant costing, as Professor Swami was mentioning, it helps us in a number of ways. Once we know which costs are relevant and which are irrelevant, we can decide whether we should produce or not. Once we decide that we should produce, it helps us in maximum utilization of the capacity. If we utilize the capacities based on these relevant cost decisions, we also optimize our profitability. And if we do that, then we go beyond the microeconomics or business economics, we go to the macroeconomics. We also maximize the employment and also the use of the resources for the firm and also for the country. So, relevant costing is a very, very important idea which tells us how we can use the cost concepts in taking decisions to go ahead with production or not. And as Professor Swami told, if we decide that we should go ahead with production, then which product? Because there are multiple products. And then, as he told, how much and when. So, these are very, very important issues which can be solved only through relevant costing. Thank you very much.
Thank you, sir. So, today we have discussed elaborately about relevant costing. The experts with us, Professor R.K. Misra, Director IP, and Professor K. Swami, Dr. B.R. Ambedkar Open University, have explained very well about the key concepts of the relevant costing. We hope that the students of MBA third year who are pursuing finance specialization would take the benefit of this.
మన ఈ ఉన్నత విద్యా కార్యక్రమాలపై మీ సందేహాలు, సలహాలు, సూచనలు మాకు తప్పకుండా తెలియచేయండి. మా చిరునామా డైరెక్టర్, ఆడియో విజువల్ ప్రొడక్షన్ అండ్ రీసెర్చ్ సెంటర్, డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ, ప్రొఫెసర్ జి రామిరెడ్డి మార్గ్, రోడ్ నెంబరు 46, జూబ్లీ హిల్స్, హైదరాబాద్ 5,33,000.